Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Good morning, and I guess afternoon for people in the recording, August 20th. Just go over a couple slides here. Canadian disclaimer, U.S. disclaimer. Just please read those if you're an investor in either of those jurisdictions. We're not giving any investment advice today.
Looking at the S&P 500 here, one box increase, really no movement over the last 2 weeks. You can see the strong support zones by those red lines there. Really a less volatile week. I mean, it seems like investors are more focused on yields and the conflict in the Middle East, and I get earlier in this week, the tariffs between Canada and the US. So kind of a lower growth week, we'll call it, less high octane to the upside and downside, really led by healthcare, energy, and defensive names this week. In terms of momentum, really seen a rebound over the last 3 weeks. Overbought, oversold 45%. That's the lowest in 3 weeks, but the highest, third highest since May 29th. So we're getting an increase in the demand for the S&P, but we did see a pullback compared to the last few weeks. Looking here at the NASDAQ, 2 column changes, 2 box decrease week over week. It did create a new buy signal. I accidentally wrote sell signal. You could see numerous resistance lines, support 1 box lower that created last week. A bunch of the semiconductor names actually pulled back slightly after their kind of roaring bounce back that we saw in the previous few weeks. And I'd say it's a flight back more to quality names, less growth, less cyclicality. Broke 11 weeks of negative momentum as well. So that's a positive for the NASDAQ, something we've been watching really closely. And then the overbought, oversold, interesting enough, only 5%. It's the third straight week it's been overbought, but that's quite low when you're really looking over the past 6 to 8 months for the NASDAQ. Looking at the Dow, no box change this week, third week in a row that's happened. You can see the nice support lines there. I continue to believe this is the strongest setup amongst the U.S. indices. I think it's because of that more of flight to quality. Investors looking for some value in defensive names, looking at the Dow as a proxy for that. Weekly overbought, oversold 35%. That's a decrease week over week. And it's the lowest in 3 weeks. So kind of the same thing in terms of demand for the NASDAQ, Dow, and S&P. But it's remained overbought every week of the summer, despite the AI sell-off that we saw in July. So something to note there. And then looking at the TSX 60, no box change as well. Like I said, not a lot of movement in the market this week, kind of these up, down, 1%, 0.5% days, led by the commodity names this week. We've seen a bounce back actually in the miners recently. And then some weakness specifically yesterday in some of the bank names, which are due to report earnings next week, as well as some of the discretionary names north of the border. So we'll have to watch that very closely. Some economic worries, obviously, on the minds of investors when it comes to north of the border. Overbought, oversold 53%. That's the lowest in 3 weeks. Demand remains, as investors, I think, are looking for commodity exposure that are less correlated to U.S. markets and U.S. tech names, which dominate U.S. markets. So really looking at Canadian names, really attractive valuations, I would say, relative to the U.S. names, but also monitoring the Canadian economy very closely. VIX near 52-week lows. We're continuing to see this move downward. It's turned over the past couple of weeks. Flat week over week. The target is 11.5%, which would push lower. But we've kind of, as you've seen, since mid-April, in this consolidation pattern where it's moved slightly lower despite some massive sell-offs in the AI names, the South Korean market in July and late June. So haven't really seen a spike in the vol despite some large market moves, we'll say, in pockets of the market. Looking here, S&P 500, bullish percentage, and the NYSE, neither of these have moved, so I'm just going to quickly flip through. Percent positive trend, the only movement we saw was the NASDAQ move up 2%. That's actually the highest point we've been at since last August, so about a year ago, a round trip. So there is some breadth in terms of companies trading in a positive trend after this bounce back that we've seen since a bit of the AI sell-off last year. Obviously, earlier this year, some of those software names have sold off, but some of them have rebounded. And that's why I think this chart's moved up pretty significantly in the last few weeks. And then the Toronto Stock Exchange, we saw a reversal in terms of the bullish percentage. I mentioned miners bouncing back. I would assume that most of this bounce back, because we're at the highest point since June, really to do with that commodity trade. Obviously, some volatility in the energy trade, up, down, up, down, up, down. I think oil trading at about $85 this week, but nonetheless, bullish percentage chart moving up, which is a positive sign for Canadian investors. And then asset class rankings. Equities were the only areas to lose buy signals. Financials actually lost a few buy signals over the past few weeks. And we've seen actually a rotation into utilities, basic materials, energy, and then consumer non-cyclical last position, but it's also picked up a number of buy signals in the recent weeks. And then commodities, the biggest gainer in terms of these asset class rankings, energy picking up the most and jumping back into the first position with the price of oil jumping back into the mid 80s this week. Looking here, this is a chart that Dorsey Wright highlights. It's the ETF PIE, P-I-E. It's the Invesco Dorsey Wright Emerging Markets Momentum ETF, which NASDAQ, Dorsey Wright, and Invesco team up for. So it's a purely momentum-driven strategy in the emerging markets. It's very volatile over time. But you can see here, we've seen a really strong bounce back after that sell-off. Obviously, these emerging markets ETFs have a lot of Southeast Asian exposure. A lot of the AI trade has been there. Those markets like South Korea, Taiwan have been hit pretty hard the past few months. So you've seen a rotation out of some of those names and into some more names with some more momentum, we'll say. It is outperforming the EEM ETF this year, which is no surprise because it's been a year full of momentum, but our exposure still remains the emerging markets ETF, EEM. So scores almost at a 4 out of 6. We'd call it a hold/buy. Up 19% year to date. You can see the nice bounce back that we've seen since that low in late July. It really remains cheap in our eyes. We think there's going to be continued rotation away from the US markets into markets that are really attractive and underpriced. Obviously, we like specific regions in the emerging markets a little better than others, but as a whole, if you want some exposure, really interesting theme right now. Looking here, this is the return of the metals, I called it. This is the relative strength for precious metals. You can see off this low in mid-July, this is relative strength. So you can, it's compared to the underlying indice, which for most of the US names is the S&P. For most of the Canadian names, it's the TSX. You can see we flipped from 8% of precious metal companies in relative strength X columns, which means they're moving up compared to the indice, to now 62 in just over a month. So quite the large swing. Obviously nowhere near the high that we saw at the end of last year, but nonetheless a strong move. And then it's also on the right side for non-precious metals moving up from about 10% at the same time all the way up to 50% right now. So really, if you're looking for some exposure, potentially now a strong time to add as it's bounced back. Looks like it's set a low for a lot of these metal prices, and they look to be moving higher. This is gold, which is actually officially above its 200-day moving average for the first time in 10 weeks. That's as of Tuesday. You can see this strong move off the bottom number of support lines here, and that's why I said it made its bottom at $4,000, sitting at about 4,400 now, and creating its first buy signal since April. So something to watch there. And then this is an interesting chart that Tavi Costa from Azuria Capital tracks. This is the gold spot price on the right axis, and then the global money supply on the left axis. You can see since the start of 2023, global money supply and gold have been pretty correlated, other than a period here in 2025 when gold eventually played catch up at the end of the year. But you can see this massive gap potentially closing. So we'll have to see. Obviously, with the global money supply growing, it is a investment case for owning gold. Obviously, recent years there's been some dislocation with that, but nonetheless, we still are really bullish on gold for a variety of factors. And it appears that investors are as well. Fund manager survey from Bank of America, gold valuation and the gold price, you can see in the blue. This is the net percentage of investors that were surveyed saying gold is overvalued. You can see earlier this year, most of investors were saying gold was overvalued, for the most actually going back to 2007 when this data set began. But we're actually at the point where we've completely reversed, where a net of 16% of the investors say gold is undervalued, the most since March of 2023, and up in terms of undervalued from 6% last month. So potentially some fund managers looking at adding some size there. Last two slides. This is just a relative strength addition that we did this month. XIT, the Canadian Tech Index, been up and down this year, down 3%. Price target's kind of neutral from where it's sitting at. In terms of valuation, since the pullback, a little more attractive. This is based on our fundamental and momentum model, and it pushed up in terms of positioning. We still have some commodity exposure, still have some defensive exposure, still have some global exposure. This I would classify more as the growth exposure within the model right now. And then last slide, U.S. Treasury 10-year. We're at multi-decade highs for a lot of these yields across the world. Not this one for the U.S. 10-year, but I wrote up in the Weekly Beacon all the major global economies that are seeing highs in terms of interest rates going back to 2011, 2008, 2009, 2007. Yesterday with U.S. yields obviously hitting their highest, specifically this 10-year, since last January for a brief period, and then predating that, I think back in 2023, the U.S. Treasury announced that they're doubling the size of their long-end buybacks to obviously improve liquidity in their words, but they're buying back their own bonds in size and potentially in the short term suppressing yields. So we'll have to see what happens with yields, because it seems like a major risk factor right now on a lot of investors' minds. And then I'll pass it back to Dave.
Yeah, thanks, Ken. I saw something earlier that talked about the U.S. government doing this during the Second World War because they just didn't have any capital, and then again in the early 50s, which brought on tremendous inflation in the 60s, like at 18%. So we haven't even seen inflation yet. If they continue to do this, of course, they feed propaganda saying that this will not be inflationary when how can it be anything but? So they just always try to trick us and think that they're just doing it from one pocket out of the other pocket. And so theirs has no effect. Well, the reality is no one wants to buy their bonds at these levels. Rates just aren't high enough. And meanwhile, their government wants rates to be lower in an inflationary environment. So it's impossible. They've really literally painted themselves into a corner. So we'll see. Okay, I'm going to start with Andrew Adams at Sought Strategy for Charts of the Week. These just came in, so the first time talking about them. Andrew sees the S&P 500 volatility. It's being overbought now after this tremendous comeback.
big picture. Yeah, I've seen this one before. This one's really, says a lot about how we're up to this. It's really a 200-month moving average, so very long term. And you can see we're getting up to levels not seen since the dot-com bubble. Interestingly, this is why many people didn't really see the credit crisis. That's the peak there. It wasn't a technical one like this one appears to be now, and back in the dot-com and the 87 crash, of course. And then the 1950s, not to be confused with the nifty 50s, which were right in this run right here. That was their tremendous run up, but still didn't get up to these excessive valuations. So, and you can really see it here on the right, how we're touching off of that 200-month moving average. Sentiment amongst money managers is frothy. So, yeah, so it always measured in cash levels. Cash levels are down to near zero. And then the bullish sentiment that Bank of America is looking at there. Margin debt. Yeah, I was talking to a client yesterday about this. Margin debt is near historical extremes. So these are the people who are going to get killed the worst and the first. If the market's down 10%, these people are immediately down 15 because of their margin and or thereabouts. And so good luck to them. If you have any friends or family that are borrowing to invest, plead with them to at least get out of debt. And if they want to hold those positions, that's up to them. What they should be doing is raising cash or coming and seeing a group like ours that has downside protection. But people will do nothing. It's safer for them in their minds to do nothing, which is frightening. Consumer electronics and software have been the best performers. Equal weighted S&P hits new highs but fades. Yeah, so that's been going up since the spring of this year. The average stock in the market just hit a new all-time high. So that's great for the average person's portfolio, because that means their portfolio will be reaching all-time highs. And that's the time when you should really take stock, pun intended, of what you're doing and what you're doing this for. This is not a game. This is real life. Chinese tech back to key spot. This is just about China. We don't really follow that because we're never going to invest in that market. We invest in markets with rule of law, and rates fall, but still a problem. Yeah, I'll show that later on the NASDAQ Dorsey Wright point and figures of rates, quote unquote, falling. This is the 30-year, which has been pushed up constantly and up to a new all-time high. Or not all-time, excuse me. A high that we haven't seen since 2007, I believe it is. Gold surges, but right to probable resistance. Yeah, so people had given up on gold a few months ago, and that's the time when it usually turns around. They're calling a bottom on Bitcoin here. Yeah, there's a little spike there, so we'll see. And that's it. I'm not going to go through their book there. I don't think it's come in this morning. It has. I don't think it makes a big difference. The morning coffee, this is from a day ago, so it will be a day behind here. But Canada is in strong double-digit returns. Look at those one-year numbers. It's just tremendous, with gold really helping out and so forth. The S&P and the NASDAQ in around the same range. The Dow a little bit lower. And then the only one in negative now is India. Still isn't able to climb out of that hole. Maybe when it turns into more of a value market, which is around the corner, that will be the time for India. Moving up here, I'll get to these commodities later, but crude's done well. So that also has juiced the Canadian stock market, but up 65% year to date. Nat gas struggling a bit. And Gold just keeping its head above water here for the year. Copper's done very well. I'll talk about our Canada US dollar later. Yeah, a lot of green. Well, not great amounts of green building in there, with Bitcoin still down 26% this year. Okay, no change in the Canada US dollar at 72 cents. Still points down to 69 in the short run and down to 62 in the long run. So the trend of this has still been accurate. The US dollar spot index is at 99, on its way to 110, and it's basically been flat this year. Okay, commodities. Oil at 84 measures up to 94. So it's going to be getting more expensive again. So that's foreshadowing more political turmoil in the Middle East with Iran. Still up 47% year to date. Whereas nat gas also looks like it's going to be wanted at 280, measuring up to 330, down 24%. This is still telling us that you can be holding and buying energy stocks, producers, up 41% this year. Copper looks like it has a little bit of upside. Uranium has quite a bit of upside from 45 to 64. Gold is up on the futures and flat on the spot. But the gold bugs and the producers, they're mixed messages there. Whereas the gold juniors look strong, silver looks strong, and the silver index looks like it's sort of flat there. Yeah, you don't really hear about how silver is in such short supply again. So that will come up again. But right now the market's taking a pause there. Platinum flat. Bitcoin still has the same target of 22,000. Ethereum up, Solana way down, and the crypto exchange index up. So mixed messages there. We're just staying out of it, probably for the foreseeable future. Ken and I looked at all the Canadian banks carefully yesterday, and this index here of equal weighted index on the Canadian banks looks like it's up, and it's up almost 30% year to date. It's hard to find names that are going to continue to grow at that rate. So we took a pass and found some other financials instead. The U.S. broker-dealers look to be strong. And then finally, moving to this managed interest rate curve, like highly managed in the U.S. 4% on the 2-year measures up to 6. 4.4 on the 5-year measures up to 5.4. 4.7 on the 10-year measures up to 5%. And the 30-year, just good for them for buying their own paper. But it looks like it's not going to do anything to push the prices down, according to Point and Figure. These are only mathematical calculations. They're not any one analyst's thoughts. They're actually an amalgam of everybody's thoughts. So I tend to follow the flow here. And that is it for me. Sean, are you ready to jump in?
Okay, so these are the macro thoughts for August 20th. My phone has been ringing off the hook with respect to Bitcoin in the last few days in Ether. So positioning, long biased as we were in SPY, triple Qs, GLD. Small VIX long position as a hedge against chaos. As Ken noted, it's quite low. We've got spot VIX at 15.5. It actually dipped below 15 briefly. Don't have any shorts on at the moment. The crypto market is fragile. We still have low exposure, even though it's jumped recently. We're not getting too crazy excited on this. The asset classes in the last week, we've seen the US dollar quite materially fall, like 2.6%. That's a huge move for the US dollar, and that was engineered by Besant, announcing a long-term bond buyback, or a new form of Operation Twist, if you will. What does this get them? Maybe short-term rates for a little while, or lower rates in the short term. It doesn't solve the problem of fiscal excess and the deficits. So this is, again, it's a lot of window dressing. it's not something I like. And maybe what they're just really announcing is, hey, Japan, we'll buy all of the long bonds that you want to sell. When we look at economics, the main thing that's changed is the hawkish bias has softened somewhat. And certainly with the Treasury move, they have reiterated that they want a weaker US dollar. Other than that, not much has changed. The Atlanta Fed GDP now number has come down from like over 5% to 4%. Still seems very high. I'm thinking like we'll be maybe seeing 1.5% to 2.25% growth this year. The US dollar, quite notably, like this is a big move in the last month from where we were up at, well over 101. Keep your eyes on this space. The US dollar is the contra asset to all of the financial assets that we buy eventually, right? You buy the S&P 500, you're exchanging it for dollars. You buy gold, you're exchanging it for dollars. When the US dollar goes lower, that's going to put the price of everything referenced in US dollars higher. The yen, the massive intervention is slowly being unwound, but it's not spiking at the moment. But we do expect their fiscal situation and spending plans to drive that currency weaker again. And at a time of elevated oil prices, that really pinches an economy that is thoroughly dependent on importing petroleum. Gold is up. We noted the basing in the yellow box previously, and we bought gold on the breakout. We continue to like the trade. And just, that and Bitcoin are doing well based on the dollar and some global trends. Oil is in a chop. The ceasefire, I guess, is officially over. Oil is not moving in any material amount through the Strait of Hormuz. There's a lot of saber rattling going on. I don't think this ends well. I think the Iranians have proven that they can stick it out and see the world drain strategic reserves. And while the U.S. is nominally a net exporter, they have high regional variations. California still apparently has to import oil for refining locally. I guess they don't have pipeline capacity or rail capacity to get distillates into the state. And slowly the reserve is getting drained, but it's mainly a global problem. Rates, nothing to say here, pretty much all the same. S&P 500 broke out of the sideways trend. We had a bull showing up in the Markov model for a couple of days, and now it's back to sideways. Correct that little typo there. We're fighting this, high margin, high valuation, people starting to think hard about infrastructure spending and AI. This morning I had to wrestle with ChatGPT, for which I have the highest paid tier, to get it to produce a comic. And basically at one point I said, like, if you're not going to produce this comic the way I've asked, then just give me a refund. And then it did it. So I guess you have to start to bully your large language models to get done what you need done. But if that continues, and I've already seen it in Claude to a large degree, people will stop using these, $100, $200, $300 a month platforms, and that is going to materially change their economics. So the AI...
Hey, Sean, do you know what percentage of people are actually paying for it like you are?
It's a small percentage, but it is very material.
Tiny.
When you look
it's tiny. And so, like you say, if that tiny percentage gets ticked off, it's going to get smaller. So
yeah,
I think it's wonderful, and it's improved some things, but I don't think it's everything that we're really cracking it up to be in terms of people catching on to it. Now, maybe I'm wrong. Maybe it's still early days.
No, you're not wrong. And the biggest failure in the whole AI space is Apple not integrating it with Siri. Right? If they did that and people understood got their heads around the full potential, I mean, the use would just go through the roof. However, I'm on the bleeding edge of this stuff. It's like the people that bought the first cars, right? They still had horses and buggies, but they bought a car. And they worked through all of the prototypes we're at a point where we're seeing companies now saying like we're got to limit our engineers in terms of how many tokens they use on a monthly basis. It's going to change all of this conversation about how valuable these things are. Remember, like SpaceX, notably, what was it, 75 or 80% of their valuation was due to what they thought would be enterprise growth of AI. So the S&P 500, I think the breadth is still okay. It's getting a little softer in the shorter term, but it was led by AI, and it will fall by AI. The equity conditions are still good. I'm not advising anybody to step out of equities. Crypto has been beaten down. I've been telling people to avoid it for, almost for year to date for sure. But it had a big pop. So Trump met with some crypto executives this week. Famously, the Senate could not get the 7 Democrats to vote with them to assure the passage of the Clarity Act. So the SEC, and the head of the SEC is a Trump bootlicker. He said, fine, we'll do the regulation, and that's going to force the politicians to come back and say, okay, fine, we'll pass this Clarity Act. So that's scheduled for September 15th. That gave crypto a bump. I still don't see a lot of use cases other than as a non-debasable asset. But with what Besant did today, some people are now making the bet on gold and with, I guess, Bitcoin, that the US is going to go back into debasing, printing money, and therefore Bitcoin should capture imaginations again. In terms of what's happening in the United States specifically, I do expect Ether to outperform Bitcoin, and that was certainly the case over the last couple of days. And notably, watch Coinbase. It will have an unbelievable run when all of this starts to come together, in my opinion. Here we see that pop of Bitcoin back up through its 200-day moving average. The heat map is pretty much clear top to bottom. 7 of 8 signals are positive. If you want it to be in Bitcoin, I would say do it now, but realize this is getting into overbought territory. It could be due for a reversal, but if you've owned it, like a number of people that I talked to have bought it, move some stops up. Don't give all of this back. I do think that the risk is still potentially, I'm not as dour as, the Dorsey Wright guys at 22, but I could see it falling to 45 literally in the next month. That's it from me.
Okay. Thanks, Sean. Chris, you there? Take it away, Chris.
Yeah. Good morning, guys. Sean very capably set out the rates market's not in great shape. And I would say after the announcement by Scott Besant this morning, US 30-year bond has pretty much given back all of its gains. And it seems like at least, in the media, the deficit is the sort of new topic to worry about as we cross the 40 trillion mark in the US. And I heard this morning that the daily interest payment is either, not sure I caught it right, 1 billion or 3 billion a day. So, sort of puts Besant's, scale Besant's buyback in context that, as we all know, interest payments are becoming a huge, huge part of the U.S. deficit. I did want to touch on the Canadian dollar, which has had a really strong rally. I guess that's partly on the back of the U.S. dollar devaluation, which you can see in the U.S. euro. The euro's up about 3 cents against the U.S. dollar, but also relative rates, Canada versus the U.S. The Canadian 10-year has risen from a low of 3.35 up to 3.75. So Canadian rates are starting to really tick up, and so I think that's driving the improvement, the significant bump that we've seen in the Canadian dollar. So on that note, I'll pass it back to you, Dave, or to Ken.
Thanks, Chris. Paul, you want to take it away? Wrap us up here?
Yeah. Hey, guys. Thanks for all that commentary. I don't have much for you because we're just watching all this volatility, positive volatility, but everything that happened in May, June, July, all reverses in August, right? So I think it's going to be a hell of an interesting fall. And this continue, dollar debasement continues, big election, right? Trump's going to, you got lots of hints. He's going to do everything he can to win some votes, right? Talking about capital gains decreases. We know he wants to lower rates. I don't think this is any coincidence. This is all happening just 3 months before the election. My anticipation is he does something in cannabis. I was at a conference, a Canaccord conference last week in Boston, met with 4 CEOs of 4 large, cannabis companies in the U.S., and all of them say that it's going to happen. Descheduling in some form or another is going to happen this year. And so if you believe that, you might want to get some exposure to that crazy space because these are the cheapest stocks. They all trade less than 5 times EBITDA, and they're also, the government's getting rid of the hemp ban, which is a $30 billion business in America. So they're going to make that illegal. That's scheduled for this year as well, and that's $30 billion in revenue that could go to these other public cannabis companies. So that's a growth driver. So what companies trade at 5 times EBITDA and have 15-20% growth, and then of course if they deschedule, they're going to go list on the on U.S. exchanges, which is going to send all these shares up substantially. We know for a fact that NASDAQ representatives were at that same conference specifically to meet with the cannabis guys. So NASDAQ is soliciting business from Canadian cannabis companies. That's just a fact, right? So that's an interesting play. We've allocated, like 10-15% of the fund to that space. I think Trump's going to do it because Trump's family can make an absolute fortune playing the stocks, playing the equities. So that's an interesting space. And then energy. I mean, I think it's so clear who can not figure out that Trump does not know what he's doing in Iran. He shouldn't have gone in and did what he did. He was advised against it. Now it's become quite clear. But and this was all predicted. The American military told them exactly what was going to happen, and it's all happening now. So I think the conclusion you can make as an investor is that they don't really have an exit solution. Iran has acted in a predictable manner, and this thing's going to continue for a longer period of time. So energy is a good place to invest. And then if you come to that conclusion, then you immediately come to the conclusion that the Canadian energy space is an ideal place to throw some money at because it's all so cheap. It's cheaper than the American public companies for sure. So they're all probably takeout candidates as well. So the American money is going to come into the Canadian energy patch, and frankly, just look at the yields. Some of the highest yielding stocks now are the energy stocks in Canada. So I think you can get quite excited about playing that space. So here are big chunks of the Canadian equity landscape that are going to do very well this fall, right? So Canada's equity market is outperforming the U.S., as Dave pointed out. Well, we predicted this a year and a half ago. It's happening, and I think it's actually going to accelerate, despite the fact that our economy is not going to do very well. So it's a weird and interesting market. So I don't know. We're doing a lot of new issues. My big fear is that there's just not enough capital to keep these equity markets going, right? You saw last night that OpenAI is going public. It's official, and then it's official. Of course, Anthropic's going to do it next month. So that's 2 more $1 trillion companies coming public in the next, call it 6 months, and that's going to knock those top 10 companies in the world in tech. Well, I guess the tech world, but I think in the world in general, the top 10 $1 trillion behemoths. They now have competition from 2 more players, and I think this is going to lead to some volatility in tech land. So keep your eyes. I mean, stay wary. This stuff doesn't go up forever, right? And we all know it's a little bit bubbly right now. So I think these 2 IPOs are very, very significant, and we're watching with great attention. So we'll see how Anthropic goes, but OpenAI is coming right behind. Announced last night. I think it's a big deal. And that's it for me.
Okay, great. Thanks, Paul. That's probably it for everybody. So I'll say goodbye and talk to you all later. Bye for now.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.